Aside from a few hiccups along the way, had you retired from 2010 onwards and had you had a decent allocation to the global stock market, you would have benefited from some fantastic investment returns which may have helped the sustainability of your drawdown funds as the investment growth may have offset the withdrawal payments. With drawdown, as the remaining pension that is not taken as income is usually invested, there is an onus on you to manage the investor portfolio and navigate any potential bear markets or volatility. As a result of this, if future investment returns are poor or if you retire before a stock market crash, this can have devastating effects on your retirement and the sustainability of your invested funds. This is often referred to as the sequence of returns risk. In layman's terms, this is the idea that if you retire just before a stock market crash and start to take an income from your portfolio, this can have an adverse effect on the sustainability of it compared to someone maybe who they retired and then enjoyed fantastic investment returns after retiring, which helped to offset any withdrawals or income payments. Who knows where the stock market is headed, and this isn't a game that I like to play, but in this video I'm going to share a few practical tips that you can use to prevent a stock market crash or low investment return period from ruining your retirement. Let's look at an example of my favourite period in history to illustrate this, the Great Depression in the US around the 1930s. Now, I must stress that this kind of period of returns is very unlikely, as back then there was no central banks bailing out the stock market as there is today. The data going back that far is probably not as accurate. From 1929 to the end of 1932, the US stock market lost approximately 85% of its value. A £100 investment at the beginning of 1928 would have risen to £143 before falling to £50 at the end of 1932 during that savage bear market. Had you have taken just a modest amount of income each year from the falling retirement portfolio, then you don't need me to tell you this would have put a further dent in the value of your pension or investment account. Now, I'm not just a scaremonger, and as we now know what the sequence of returns risk actually is, what can you potentially do to offset this risk if you are in retirement or on the cusp of retiring? The examples of the Great Depression earlier were based on an all-equity portfolio. Equities have the potential for large returns and have historically rewarded long-term investors, but they can be extremely volatile from year to year. To prevent a stock market crash ruining your retirement, one option you could consider is diversifying across other asset classes such as high-quality bonds, which can often act as a flight to safety during times of panic. If we look at the same period from 1928 to 1932, in which US stocks were ravaged as we'd seen, you can see how US Treasuries actually experienced a positive return over this same time period. You aren't even just limited to US stocks and US Treasuries either. There are many other asset classes that you can potentially turn to which could be a source of diversification, such as gold, short-term bonds, international stocks and cash, as you can see in this chart, which looks at the best and worst performing asset classes over the past 30 odd years or so. There is no guarantee that the correlation between stocks and bonds will continue, that as stocks go down, bonds go up, as both asset classes were hammered in 2022 following the war in Ukraine, subsequent high inflation and the sharp rise in interest rates. If you accept that volatility within an investment portfolio is almost certain and it's very likely that you're going to experience a number of bear markets during an investment horizon of 30 plus years, one option to negate this risk is to use a withdrawal strategy to ensure you're taking a sensible and sustainable amount of income from your portfolio. One common method is a static withdrawal rate, such as 4% of the starting portfolio value. This is commonly referred to as the 4% rule and was centered around financial planner William Bengen's research, which found that in a study during some of the most savage bear markets, no historical case existed during this period in which a 4% starting annual withdrawal rate would have exhausted a retirement portfolio over a retirement of 33 years or less. Now, this is not to say that 4% is the figure to go with, as even Bengen said you could potentially take more than this, whilst others would say that for international investors, 3% is a more appropriate figure. The idea is that at least being aware of how much income you're taking is a good starting point. One of the most troubling studies I've seen is by the FCA, which found that the average retiree in drawdown was withdrawing over 8% of their pension. If these figures are correct, and it's not just tax-free cash withdrawal lump sum skewing the figures, this is very worrying. Retirees may unknowingly be walking into a retirement crisis, as the state pension alone may just not be enough for many retirees looking to enjoy a half-decent or comfortable retirement. The trouble with using a static withdrawal rate blindly is that it doesn't react to changing environments. So if market returns are positive perhaps, or really high, perhaps it's okay to take more income to reflect this increase in your portfolio value. Equally, if returns are poor over a protracted period, it may be more prudent to reduce your income. I'm going to make a video on this, which is called looking at the guardrails approach in a dynamic withdrawal strategy. Essentially, the approach of this is that if your portfolio increases or reduces by more than 20%, you can adjust the starting income upwards or downwards by 10%. And the guy who looked at this, a chap called Guyton, calculated that the maximum initial safe withdrawal rate for this period was 5.8% for a portfolio made up of 65% equities. This actually increased to a whopping 6.2% initial withdrawal rate for a portfolio made up of 80% equities. If you are concerned about retiring just before a stock market crash or even during your retirement, one option to consider is keeping a certain amount of income in cash, such as maybe a year or a couple of years worth of income in cash, either within your pension or investment account or in an actual personal savings account separate to it. The benefit of this are that if the proverbial does hit the fan, rather than drawing down on a falling investment portfolio, you could access your cash-based savings instead and hopefully wait until you're invested with funds recovered in value. With interest rates at record levels, if you do a bit of research, it's also possible to lock in some very attractive interest rates. Most platforms have also increased their interest rates after getting a bit of a bollocking from the FCA post-Consumer Duty for pocketing some of the interest. If we look at a portfolio made up of 50% US stocks and 50% 10-year US Treasuries, if we look at some of the past bear markets and drawdowns, we can see how long it takes for the portfolio to recover. Had you had a year or 2 years worth of income in cash, you could perhaps turn off the income from your retirement portfolio or pension and then draw the income from your savings in the hope that you can weather the storm and your portfolio can perhaps recover some of its value. It also has to be said that historically, at least, cash returns have been lower than traditional asset classes and even inflation, so having an outsized or large weighting to cash could be a drag on your future return. Another option, which might not be very popular if a stock market crash does happen on the eve of your retirement or during your retirement, or if you simply don't think that you've got enough to retire, would be to delay retirement altogether or maybe work part-time. This will of course depend on many factors, such as how much income you plan on taking, your other retirement income streams, and how long your retirement is estimated to be, which I accept as how long is a piece of string exercise. If you were, however, to go down this route, the benefits of this would be twofold. You would perhaps give your portfolio a chance to recover some of the losses. You'd be taking less income because your retirement term is simply less, and you may even increase your pension with further contributions. Now, I accept this isn't a decision to be taken lightly, so please get some professional help if you think you're going to fall into this category. Being aware of the pitfalls of drawdown and volatility in financial markets is extremely important. But watch this video if you're perhaps considering drawdown or you're in drawdown, which looks at how you can take an extremely tax-efficient income from your pension.